Welcome to the Deep Dive. Today we're jumping into the Q1 2025 earnings call for Grieg Seafood.
Yeah, and this one, it felt a bit different, didn't it? Not just ticking the quarterly box.
How so?
Well, management, they were pretty open about the tough times recently, but the real focus, the whole tone, was about a pivot, a strategic pivot.
Towards?
Financial discipline, basically. Profitability, getting the balance sheet stronger, less about chasing growth, more about solid execution. It felt, I don't know, grounded, realistic.
Okay, and we saw some signs of that in the actual Q1 numbers.
We did. Group operational EBIT, that's the core farming profit, right? Was 220 million NOK. Works out to 10.6 NOK per kilo for the group.
But the interesting part is digging into that number, isn't it?
Exactly, because if you pull out just the Norwegian operations, their EBIT per kilo was way higher, 24 NOK. It kind of shows you where the engine room is, operationally speaking.
Right, and costs. Any movement there?
Yeah, improvement. Group farming costs dropped by 3.4 NOK per kilo compared to Q4. So moving in the right direction.
And the cash situation looked better too.
Significantly better. About 1.2 billion NOK improvement in cash during the quarter, which, ties directly back to that theme they kept hitting.
The shift away from growth at all costs.
Precisely. Financial robustness, cutting down debt. This quarter feels like they're really trying to turn the ship.
And they actually did stuff, took action. Not just talk.
Yeah, you saw it in the committed CAPEX, the spending plans. They pulled back quite a bit there, a concrete example of that shift.
Okay, so the headlines show progress, but there's obviously more underneath.
For sure. That's what we need to unpack now, right?
That's okay.
Get into the regional differences, the financial juggling act, and what they see coming for the rest of the year.
All right, let's do it region by region. Makes sense to start with Norway. Helen.
Yeah.
This is like the powerhouse.
Definitely. Performance there is, consistently strong, right up there with the best in the business. And their harvest volume, it actually beat their own guidance by 900 tons.
What drove that?
Good growing conditions, they said, and really low mortality. But the really interesting bit was the quality improvement.
Ah, the vaccination program.
Yeah, tackling that Moala heart issue. It pushed their superior quality share way up, from 57% last year to 83% this quarter. That's a big jump.
And how did that flow through to the bottom line and how on?
Strong operational EBIT, 260 million NOK, which is pretty good considering prices were actually lower, down 13 NOK per kilo from Q1 last year.
So the cost savings must have been significant then.
Huge. An 8 NOK per kilo improvement in costs. They put it down mostly to harvesting from biologically a really strong site.
And looking ahead for hailing costs.
They expect things to settle around 60 NOK per kilo from Q2, which interestingly is still a bit lower, 3 NOK lower than what they'd guided for previously.
Okay, and the big post-smolt facility there, Oradol.
Right, they stocked the first fish right at the quarter's end. Big fish too, 1.5 kilos, which they seemed pleased about, kind of validates their larger post-smolt strategy. Facility's on track.
Good. Moving down to Rogaland then.
Rogaland, yeah. Q2 harvest estimate is 9,200 tons. Full year guide staying at 30,000 tons. They did flag costs might be somewhat higher there in Q2 specifically.
Higher than film.
Yeah, they clarified that the 60 NOK target is more long-term for Rogaland. Q1 sites were good, but Q2 might see costs tick up a bit more towards, let's say, typical levels for the region.
Got it. And then way up north, Finnmark. Expectations seem high there.
They are. After a couple of rough years, they went into 2025 with a lot of fish in the water, high biomass, looking healthy.
And Q1 delivered.
It did. Harvest volume was actually 500 tons over their guidance. They feel like the changes they've made, vaccinations, better treatment capacity, site structure are starting to pay off.
Prices and quality improving too.
Yep. Price up to 81.3 NOK per kilo. Better size, better quality. Superior braid share climbed from 47% last year to 64%. Still room to improve, but progress. Again, linked to biology.
But wasn't there an issue? A disease outbreak?
Yeah. CMS cardiomyopathy syndrome on one site. They said it won't really hit the full year volume significantly.
But there's a cost impact.
Yes, because they had to harvest smaller fish early from that site. They estimate a 25 to 30 million NOK hit in Q2 specifically because of that. Lower prices for smaller fish, basically.
Understood. So Finnmark outlook for Q2 and the year?
Just under 8,000 tons harvest expected in Q2. Full year guidance holding at 32,000 tons. That's a big jump, 25% up from last year. Q1 EBIT was 110 million NOK, driven by those better prices and cost improvement too, over 3 NOK per kilo.
Okay, let's cross the Atlantic. Canada, British Columbia first.
Right. BC, no real commercial harvest in Q1, just some brood stock. So yeah, loss of 28 million NOK there. Harvest starts up again early Q2.
How's the biology looking now? Any repeats of past issues?
Production seems stable, freshwater and seawater. No major incidents like low oxygen or algae blooms recently, which is good. But, and this is a key point, the fish they are harvesting soon will be expensive.
Why is that?
Because of those environmental problems last year, they messed with the growth cycle, so the costs baked into those fish are high.
And mortality rates.
The 12-month rolling number came down a bit to 84%, but they were quick to point out that's mainly old bad events dropping out of the calculation, not some sudden miracle cure.
And the political situation there is still uncertain.
Very. Tariffs, the open net pen ban risk. It means they're being super cautious with investments in BC, just sticking to essentials for now.
Although they did mention a slightly more positive vibe from the new government.
Yeah, a potential shift in tone, they said. More talk about economic growth, jobs, and aquaculture. They see that as maybe constructive. Cautiously optimistic, perhaps?
Harvest guidance for BC.
4,000 tons in Q2, 12,000 for the full year. Focus is just keep costs tight and wait for regulatory clarity.
Did anyone ask about revisiting a sale or partnership in Canada now tariffs are easing?
They did. And the answer was basically, yeah, they're open to all options. They admitted they probably can't unlock the full potential there all by themselves. So reading between the lines, a strategic review isn't off the table.
Okay. East Coast Canada then, Newfoundland.
Newfoundland? Biologically performing okay despite cold water, good survival. They finished harvesting their second generation in Q1, really high quality, 95% superior, good prices.
But financially?
That's the tough part, especially now with the company tightening its belt. It's a greenfield project, long-term potential maybe, but right now it's squeezed by that capital discipline focus.
Because it's not at scale yet.
Exactly. Production is subscale, not enough volume to run things efficiently, so farming costs are really high. They booked a big impairment, a write-down on it back in Q4.
So what's the plan?
Find a way forward that doesn't just bleed cash, essentially. Stop the losses.
No harvest coming from there soon then?
No harvest in Q2. It'll pick up again in Q4. Full year estimate is 10,000 tons. And a big signal of that discipline was chopping over 600 million NOK from group CAPEX commitments. Most of that came from pausing work, demobilizing the PSA site in Newfoundland.
So they are actively looking for solutions in Canada?
Explicitly. Exploring strategic options to, quote, minimize loss-making. Someone asked about accounting, if they did sell or partner, and the CFO clarified it would be based on fair market value then, it could be profit or loss, and reversing old impairments is tricky while you still own the asset.
Right. Let's pivot to the overall financials then. Management sounded quite direct here.
Oh, yeah. The CFO basically said, look, we're not yet in the green, and the current debt load is not sustainable. Pretty clear message. Serious about fixing the balance sheet.
And that EBIT number we mentioned earlier, it had some extras in it.
It did. 68 million NOK of one-off costs. Things like restructuring charges for the new strategy and shutting down that Newfoundland PSA site. Necessary costs for the pivot was the framing.
How about cash flow from operations?
Positive. 158 million NOK in Q1. Step, And investment, CAPEX, definitely down. 167 million NOK in Q1. Much lower than recent history.
With a clear focus for that spending.
Yeah, two main reasons now, they said. One, make things more stable and robust, mainly in Norway, and try to cut the losses in Canada. Two, expand downstream processing. The Godin facility should start late this year. Alamo gets fish early 2026.
But the overall investment for the year is still pegged at?
Around 950 million NOK. That's the guidance. Still a lot, but way down from before.
Okay, financing. The big news was the hybrid bond, right?
Absolutely. 2 billion NOK raised. But they were very, very clear, calling it a temporary fix, just to get enough breathing room, enough liquidity for now.
And what did they do with that money?
Paid off debt. 500 million NOK bridge loan from Q4 got repaid. They bought back 173 million NOK of their own bonds in Q1, and the rest, about 1.2 billion NOK, is set aside to pay off their green bond when it's due.
So where does that leave their liquidity position now?
Going into Q2, they have about 2 billion NOK in free liquidity, including bank lines they haven't drawn down, the RCFs. They stress they're not about to breach any loan rules, covenants, and they think they have enough cash for operations near term.
And they want to keep those bank lines free if possible.
Exactly. Keep the RCFs, about 650 million NOK, as a safety net for flexibility. They reckon they have enough cash to get them through until the big one closes.
The Pinmax sale leaseback. Still happening.
Still happening. Ongoing. Apparently, they've actually relaunched the process based on feedback. targeting international infrastructure investors now specifically.
And the timeline and value.
Expecting it to close in the second half of this year, and they're hoping for maybe a 5% to 10% bump in value compared to what they were talking about before. But the key message was, this deal is crucial.
Crucial for what?
For liquidity. They expect 1.1 to 1.2 billion NOK from it, and they basically said that cash injection will be enough for the rest of this year and into next year. It's clearly underpinning the whole plan.
Okay, let's wrap the outlook and market view together. Long term for salmon.
Still strong fundamentals, they believe. Good underlying demand. But for this year, expect low and volatile prices. That was the message.
And the market itself in Q1.
Well, Norwegian exports were actually up quite a bit, 19%. Better quality fish, heavier weights helped, good conditions. But spot prices, yeah, they were lower and jumpier than expected.
And Grieg Seafood's own contract coverage.
For their Norwegian fish, it's 30% contracted for Q2 and 26% for the full year.
Any comments on tariffs or trade stuff?
They don't see big direct impacts on salmon from recent tariffs and the Canada-US zero tax deal. They view that as a positive for their BC operations.
And overall volume guidance for 2025.
Holding firm at 84,000 tons total across all regions. Robust guidance.
Cost per kilo expected to improve overall.
Yes, underlying trend should be downwards thanks to biology and the focus on efficiency. But they warned Q2 costs will be higher in Rogaland and Finnmark specifically. Partly site mix, partly that CMS impact in Finnmark we discussed.
So the big picture message remains. Transition year.
Absolutely. 2025 is all about cost control, capital discipline, executing this transformation plan, assessing every region. And they explicitly link this whole shift away from just growth towards profit to the new Norwegian aquaculture tax, the havbruksskatt. That tax setup definitely encourages focusing on profitability, not just pumping out volume.
Okay, so if we step back, we see a company clearly in transition, making real operational progress, especially Norway, making big financial moves, cutting spending, getting that hybrid bond done.
Yeah, definite steps. But management themselves are saying, we're not out of the woods yet, and you can't ignore how much hinges on getting that Pinmax sale leaseback done and done smoothly in the second half. It feels like the critical piece for near-term stability.
This is not financial advice.
Let's be absolutely clear. What follows is purely speculative thinking based only on the information from the earnings call we've just discussed. It is absolutely not financial advice, just an idea to illustrate a point.
Okay, so framed as that kind of thought experiment, given how much management stressed the necessity of the Pinmax sale for liquidity, calling the hybrid bond a temporary fix.
And acknowledging that even with Norway improving, the overall financial turnaround really depends, critically depends, on that specific asset sale closing in H2.
You could maybe construct a rationale, purely hypothetically, for considering something like a short position or maybe buying put options on Grieg Seafood shares, say with an expiry late in the second half of 2025.
And the idea wouldn't be a bet against the fish growing well or costs eventually coming down.
No, not really. It would be more a bet that the market might be underappreciating the execution risk tied specifically to that Pinmax deal, the risk that something goes wrong.
Right. If that deal gets delayed or the price isn't what they hope, or worst case, it falls through, well, the company's own plan for bridging their liquidity gap and getting debt down comes under serious pressure.
Which could force them into maybe less favorable financing options down the road than what the market expects right now. So it's less about farming risk, more purely about the financial execution risk on that one key deal. Does it happen on time and as planned?
And again, just stressing, this is derived from the call details, purely illustrative, definitely not advice.
So wrapping up, Grieg Seafood's Q1. It shows they're taking tangible steps in a really critical turnaround, moving towards financial health, focusing on profit.
Absolutely. But they're navigating tricky waters, as they acknowledged. And the success of those financial plans, particularly landing that Pinmax sale leaseback as expected, looks absolutely pivotal for them in the near term.
So here's a final thought for you, the listener, to mull over. Thinking about everything we've discussed, how does the success or potential failure of that one specific asset sale truly change the game for Grieg Seafood's financial path, the risk involved, and ultimately the investment story over the next 12 months?